What if the next massive move in Bitcoin isn't being decided by Bitcoin alone? What if the real signal that could push Bitcoin toward $100,000 or crash it toward $35,000 is actually coming from gold? Right now, something very unusual is happening in the financial markets. For centuries, gold has served as the ultimate safe haven asset. Whenever global tensions rise, whenever inflation surges, whenever investors fear economic collapse, gold is usually the first place money flows. But today, Bitcoin is starting to challenge that dominance in a way we haven't seen before. And one specific indicator, the Bitcoin-to-gold ratio, may be quietly signaling where the entire crypto market could go next. Because at this very moment, Bitcoin has just rebounded from one of the most important support levels in its entire market structure, while gold continues to hold strong bullish momentum. And the battle between these two assets could determine the next phase of the global financial cycle. To understand what's really happening, we first need to look at why investors treat Bitcoin and gold so differently, even though they are often placed in the same category. Gold has served as a store of value for thousands of years. Empires have risen and fallen. Currencies have collapsed. Financial systems have been rebuilt. But gold has remained one of the most trusted assets in human history. Its supply grows slowly. It cannot be easily created out of thin air, and it has been recognized globally as a form of wealth preservation for centuries. Bitcoin, on the other hand, is relatively new. It was introduced in 2009 during the aftermath of the global financial crisis as a decentralized digital asset designed to operate outside traditional financial systems. Unlike gold, Bitcoin exists entirely on a digital network. Its supply is mathematically limited to 21 million coins, and its issuance is controlled by code rather than central banks or governments. Because of this scarcity and independence from traditional financial systems, many investors have started to refer to Bitcoin as digital gold. But while both assets share the concept of scarcity and long-term value storage, their behavior in financial markets is often very different. Gold tends to respond more strongly to long-term macroeconomic risks. When inflation rises, when currencies weaken, when debt levels explode, gold typically benefits because investors seek stability. Bitcoin, however, reacts more quickly to liquidity conditions and investor sentiment. When financial markets are optimistic and risk appetite increases, Bitcoin often rallies much faster than traditional assets. But when uncertainty spikes suddenly, Bitcoin can also experience sharp volatility as investors temporarily shift toward more traditional safe haven assets like gold or government bonds. And that dynamic has been playing out once again in recent weeks. The latest geopolitical tensions involving Iran created a wave of uncertainty across global markets. During the initial shock of the conflict, investors rushed toward traditional safe haven assets. Oil prices surged, volatility increased, and financial markets reacted rapidly to the possibility of escalating tensions in the Middle East. Bitcoin was not immune to that reaction. During the first wave of uncertainty surrounding the US-Iran situation, Bitcoin experienced a sharp decline and briefly dropped toward the $60,000 level. This price zone is extremely important from a long-term technical perspective. For months, analysts have identified the $60,000 region as one of the strongest structural support zones in Bitcoin's market cycle. And when the price reached this level, something interesting happened. Instead of collapsing further, Bitcoin found strong buying pressure. Large buyers stepped in, the selling momentum slowed, and the market began to stabilize. From that support level near $60,000, Bitcoin quickly rebounded and climbed back toward approximately $71,000. At the same time, global markets began reacting to new developments. Statements from U.S. President Donald Trump suggested that the conflict might de-escalate sooner than expected. Those comments had an immediate impact on financial markets. Oil prices began falling, equity markets stabilized, and the extreme risk-off sentiment that had dominated the earlier days of the conflict began to ease. When geopolitical fears start to decline, investors often rotate their capital back into risk assets, and that appears to be exactly what happened. Over the past 10 days, Bitcoin has gained more than 5%, showing renewed strength after its rebound from the $60,000 support zone. Meanwhile, gold, which had initially benefited from the geopolitical uncertainty, has actually declined slightly during the same period. In fact, gold prices have dropped by around 2% in March so far. This divergence between Bitcoin and gold is significant because it reflects a shift in short-term investor psychology. When investors expect chaos, they often buy gold. When they expect recovery or stabilization, they tend to move back toward assets with higher potential returns.
Bitcoin sits at the center of that dynamic. And this is where one of the most important indicators in the market comes into play: the Bitcoin to gold ratio. The Bitcoin to gold ratio is exactly what it sounds like. It measures the relative performance of Bitcoin compared to gold. When the ratio rises, it means Bitcoin is outperforming gold. When the ratio falls, it means gold is outperforming Bitcoin. This ratio has become a powerful tool for understanding how investors are positioning themselves between traditional safe haven assets and emerging digital assets. Historically, when risk appetite increases across financial markets, the ratio tends to move higher. But when investors become more defensive, the ratio often declines as capital shifts toward gold. Looking at the long-term chart of the Bitcoin to gold ratio reveals something very interesting. Back in September 2025, the ratio broke below a large triangle pattern that had been forming for an extended period. That breakdown triggered a strong correction in Bitcoin relative to gold. Shortly after that breakout, Bitcoin itself began declining toward the $60,000 level. In other words, the ratio signaled weakness in Bitcoin even before the full correction played out. Today, the ratio has reached a critical level once again. It is now stabilizing just above a major long-term support zone around the level of 13. This level has acted as a strong floor for the ratio in the past, and once again, the market is testing whether that support will hold. If the Bitcoin to gold ratio breaks below the level of 13, it could signal that gold is regaining dominance over Bitcoin. In that scenario, analysts warn that Bitcoin could experience a much deeper correction, potentially falling toward the $35,000 region. However, the opposite scenario could be equally dramatic. If the ratio confirms a strong bottom at this support level and begins rising again, it could indicate that Bitcoin is preparing to outperform gold significantly. And that type of shift in capital flows could support a major rally in Bitcoin prices. Some analysts believe that if the ratio begins trending upward again, Bitcoin could eventually target levels near $100,000. But to fully understand that possibility, we also need to examine Bitcoin's own technical structure. Right now, Bitcoin's long-term chart is showing a pattern known as an ascending broadening wedge. This pattern forms when price creates higher highs and lower lows within expanding boundaries. The support line of this wedge currently lies within the $50,000 to $60,000 region. This makes the $60,000 rebound particularly important, because as long as Bitcoin continues consolidating above the $50,000 level, the broader bullish structure remains intact. In fact, many technical analysts believe that holding this support zone could eventually lead to a major recovery rally. If the pattern plays out in a bullish direction, Bitcoin could gradually climb back towards six-figure territory over the coming market cycle. But there is still a critical risk that cannot be ignored. Bitcoin is currently trading more than 40% below its previous peak of around $126,000. That kind of decline represents a massive correction, and historically, markets rarely recover instantly after such large drawdowns.
Instead, they often go through long periods of consolidation where confidence slowly rebuilds. This means that even though the $60,000 support level has held so far, the market still needs time to stabilize. Institutional investors, hedge funds, and large asset managers are carefully watching these levels. They're monitoring macroeconomic trends, liquidity conditions, and geopolitical developments before committing large amounts of capital. Because Bitcoin no longer exists in isolation, it is now part of the broader global financial system. Its price movements are influenced by interest rates, central bank policies, global liquidity cycles, and geopolitical risk events. And that is why the relationship between Bitcoin and gold has become so important. Gold represents stability. Bitcoin represents innovation and risk-adjusted growth. And the constant competition between these two assets reveals where investors believe the future of value storage may be heading. If the global economy enters a prolonged period of instability with rising inflation, currency devaluation, and increasing geopolitical conflicts, gold may regain dominance as investors seek safety. But if financial conditions begin improving, liquidity returns to markets, and investor confidence strengthens, Bitcoin could once again become one of the most attractive assets for capital growth. The recent rebound from $60,000 suggests that many traders are willing to step back into the market when extreme fear begins to fade. However, the coming months will likely determine whether this rebound evolves into a sustained recovery or simply a temporary relief rally before further volatility. And that brings us back to the Bitcoin to gold ratio, because this single indicator may quietly reveal which asset is winning the battle for investor capital. If the ratio starts climbing again, it could signal that Bitcoin is regaining leadership. But if it breaks below its long-term support, the market could face another wave of downside pressure. Right now, the entire crypto market is watching closely, because the next move in Bitcoin may not only shape the future of digital assets, it may also reveal whether the world is ready to trust a digital store of value more than a metal that has defined wealth for thousands of years. And in a financial system that is constantly evolving, that question may become more important than ever.